The hidden cost of keeping too much cash in savings. You may have done this recently, opened your savings account, saw a balance of $50,000, $75,000, or even $100,000, and felt a little more secure. You may even have told yourself, at least the money is safe. But here is the uncomfortable reversal. The money that feels safest can quietly become one of the most expensive financial decisions you make. Not because your bank is stealing from you, not because savings accounts are useless, and not because you should invest every dollar you own. The real problem is that cash has two different prices. There is the price you can see, which is the interest your bank pays you, and there is the price you cannot see, which is the purchasing power and future growth you may be giving up. Most people focus on the first number and completely miss the second. So today we are going to calculate what happens when a household keeps too much money in savings instead of giving some of it a longer-term job. We will use a realistic American household, a $100,000 cash balance, a $36,000 emergency reserve, and $50,000 of excess cash. By the end, you will know exactly when cash protects you, when it costs you, and how the decision changes over 5, 10, 20, and 25 years. This is not a case against emergency funds. It is a case against confusing an emergency fund with a retirement strategy. Let us first establish the playing field. Assume this household spends $6,000 per month on essential expenses. 6 months of essential expenses would therefore equal $36,000. That $36,000 is not excessive if the household has a mortgage, children, one primary income, or a job that would take several months to replace. The Federal Reserve reported that 63% of adults in 2025 said they could cover a hypothetical $400 emergency using cash, savings, or a credit card paid off at the next statement. Source: Federal Reserve 2025. That statistic matters because it explains why cash feels emotionally powerful. For millions of households, cash is not an optimization problem. It is the difference between paying an unexpected bill and creating a new financial crisis. So if you do not have an emergency fund, building one is usually a priority. But this video is about the household that already has a reserve and keeps accumulating cash beyond the amount its real risks require. Now, let us make the assumptions clear. We will assume the savings account earns 4.50% per year. That is an illustration, not a promise about what every bank pays. We will also assume the household is in the 24% federal marginal tax bracket. Under the 2025 IRS tax schedule, married couples filing jointly enter the 24% bracket above $206,700 of taxable income, while single filers enter it above $103,350. Source: IRS 2025. Savings account interest is generally taxable in the year it becomes available, even if you leave the money in the account. Source: IRS Topic 403. Finally, we will use 2.7% inflation for the baseline. The Consumer Price Index rose 2.7% from December 2024 to December 2025. Source: Bureau of Labor Statistics 2026. These assumptions create a simple question. If your savings account pays 4.50%, and your federal tax rate is 24%, what do you actually keep? The calculation is 4.50% multiplied by 76%. That produces an after-federal tax return of approximately 3.42%. If inflation is 2.7%, your approximate real return is only about 0.70% before state and local taxes. In plain English, your money may be growing in dollars while barely growing in purchasing power. That is why this is not your fault. The account statement shows a positive number. The bank sends you interest. Your balance rises every month. The loss is invisible because it happens in the gap between dollars and what those dollars can buy. Now, let us look at the conventional choice. You have $100,000 in savings. You are earning interest. You are avoiding stock market volatility. You are not worried about having to sell investments after a market crash. And if your car breaks down, your roof leaks, or your employer cuts your hours, you can pay the bill immediately. That sounds like a responsible financial decision because in many ways it is. Cash gives you liquidity. Liquidity means you can access the money quickly without waiting for a buyer or accepting whatever price the market offers. Cash also gives you psychological stability. If the stock market falls 30%, a $100,000 stock portfolio could temporarily fall to $70,000. A $100,000 savings balance does not normally behave that way. For a person who would panic sell during a market decline, keeping more cash may prevent a permanent mistake. This is where loss aversion appears. Loss aversion is the tendency to feel a loss more intensely than an equal gain. Seeing an investment account fall by $20,000 can feel more painful than seeing it rise by $20,000 feels satisfied. Because of that psychology, a person may choose a lower expected return simply to avoid seeing temporary losses. That decision can be rational if it helps the person stay invested. It can also be rational if the money is needed within the next few years. If you are buying a house next year, paying college tuition in 18 months, or expecting a large medical expense, market volatility is a serious risk. A savings account may be exactly the right tool for that money, so the conventional choice deserves real support. Keeping cash can protect your household from forced borrowing. It can protect you from selling investments during a downturn. It can give you negotiating power when a job opportunity appears. And it can prevent one unexpected expense from turning into high-interest credit card debt. The question is not whether cash is good. The question is whether every dollar in the account still has a job that requires cash. Here is what changes the whole calculation. Once your cash reserve is larger than the risk it is designed to cover, the money stops functioning mainly as protection and starts functioning mainly as a low-return investment. The first hidden cost is inflation. Suppose you keep $50,000 of excess cash in the account for 10 years. At a 4.50% interest rate, taxed at 24%, that $50,000 grows to approximately $69,987 before considering inflation. But after applying 2.7% annual inflation, its purchasing power is only about $53,618 in today's dollars. That means 10 years of saving produces less than $3,700 of real purchasing power growth. The account looks like it earned almost $20,000. Inflation and taxes quietly absorb most of that increase. The second hidden cost is the tax drag. At a 4.50% interest rate, $50,000 generates $2,250 of interest in 1 year. At a 24% federal marginal rate, approximately $540 of that interest goes to federal income taxes. That leaves approximately $1,710 before state and local taxes. The IRS generally requires taxable interest from bank accounts to be reported as income. Source: IRS Publication 550. If your state tax rate is 5%, another $112.50 could be owed on the original $2,250 of interest. Your combined after-tax interest could then fall to approximately $1,597.50. That is a 3.20% after-tax return rather than 4.50%. The rate on the bank advertisement is not the rate your household keeps. The third hidden cost is opportunity cost. Opportunity cost is the value of the next best alternative you gave up. If the $50,000 remains in savings, it earns the after-tax cash return we just calculated. If the same $50,000 is invested in a diversified portfolio for a long-term goal, the expected return may be higher, but the value will fluctuate. For the comparison, we will use a 7% annual real return for the invested alternative. That is an assumption based on the long-term historical relationship between stock market returns and inflation, not a guarantee. Historical data compiled by New York University's Aswath Damodaran show long-term annual returns for the S&P 500, including dividends, along with Treasury bill returns and inflation-adjusted comparisons. Source: NYU Stern, 2026. The key distinction is that the savings account offers relatively stable nominal dollars, while the investment portfolio offers uncertain short-term results and a higher long-term growth target. After 5 years, the $50,000 held in cash have approximately $51,777 of purchasing power under our assumptions. The same $50,000 invested at 7% real growth would be approximately $70,128. The difference is approximately $18,350 in today's dollars. That is the first major aha moment. The cost of excess cash may not appear as a visible loss. It appears as a future balance you never received. The fourth hidden cost is mental accounting. Mental accounting is the habit of assigning different emotional rules to different pools of money, even when the dollars are economically interchangeable. You may call one account emergency savings, another future security, and another money I cannot touch. But if all three accounts hold cash earning roughly the same after-tax return, the labels do not create additional wealth. The labels may actually make the money harder to evaluate. A household can gradually increase its emergency fund from $36,000 to $50,000, then to $75,000, then to $100,000. Each increase feels prudent because the account is associated with safety. But if monthly essential expenses remain $6,000, a $100,000 reserve represents approximately 16.7 months of essential expenses. That may be appropriate for a household with unstable income or a major upcoming expense. It may be excessive for a household with two stable incomes, strong insurance, and accessible retirement assets. The fifth hidden cost is the sunk cost fallacy. The sunk cost fallacy is the tendency to continue a decision simply because you have already invested time, effort, or emotion into it. You may think, I worked hard to build this cash balance, so moving any of it would be irresponsible. But the past effort does not determine the best use of the money today. The correct question is not, how did I accumulate this cash? The correct question is, what job should each dollar perform from this point forward? Now, let us run the long-term simulation. We will compare two choices for $50,000 of excess cash. Choice 1 keeps it in savings at 4.50%, taxed at 24% with 2.7% inflation. Choice 2 invests it for a long-term goal at a hypothetical 7% annual real return. These are not promises, they are decision-making assumptions designed to show how time changes the math. At the 5-year checkpoint, the cash alternative has approximately $51,777 of purchasing power. The invested alternative has approximately $70,128 of purchasing power. The gap is approximately $18,350. At the 10-year checkpoint, the cash alternative has approximately $53,618 of purchasing power. The invested alternative has approximately $98,358. The gap is approximately $44,740. Notice what happened. The cash balance did not collapse. It grew from $50,000 to almost $70,000 in nominal terms, but the invested alternative nearly doubled in real purchasing power. This is where compounding becomes visible. Compounding means that returns begin generating additional returns, so the growth rate applies to an increasingly larger balance. Cash also compounds, but a much smaller after-tax inflation-adjusted return produces a far weaker curve. At the 20-year checkpoint, the cash alternative has approximately $57,498 of purchasing power. The invested alternative has approximately $193,484. The difference is approximately $135,986 in today's dollars. The original decision was made with $50,000. 2 decades later, the difference is larger than the original amount itself. This is the point where a small allocation decision becomes life trajectory language. The question is no longer whether you earned an extra few $100s of interest this year. The question is whether your future self has an additional $135,986 of purchasing power available for retirement, healthcare, or family support. At the 25-year checkpoint, which could represent age 40 to age 65, the cash alternative reaches approximately $59,542 in today's dollars. The invested alternative reaches approximately $271,372. The difference is approximately $211,830. That is more than 4 times the original $50,000 excess balance. Again, the investment outcome is not guaranteed. A diversified stock portfolio can decline sharply. There may be years when the invested balance is below $50,000. There may be a decade when returns disappoint. But the central math remains important. Money needed soon should not be exposed to unnecessary market risk. Money needed decades from now may be exposed to a different risk, failing to grow enough to support the future lifestyle you want. Let us translate this into a practical household structure. First, identify your essential monthly expenses. If that number is $6,000, then 6 months equals $36,000. If you have one income, variable commissions, a specialized career, or a difficult-to-sell house, you might choose 9 months or 12 months. A 12-month reserve in this example would be $72,000. Second, separate no near-term expenses from true emergencies. If you know you will need $20,000 for a vehicle, tuition, a home repair, or taxes within the next 3 years, that money should not be treated as long-term investment capital. Your short-term reserve could therefore be $72,000, while the additional $28,000 has a different time horizon. Third, assign each remaining dollar a time horizon. Money needed within 1 year generally belongs in cash or a cash equivalent vehicle. Money needed in 1 to 5 years requires a more cautious allocation because the date of need matters. Money not needed for 10, 20, or 25 years can potentially tolerate more volatility. Fourth, automate the transfer. If you decide that $25,000 is excess cash, moving it once may feel emotionally difficult. Moving $2,083 per month for 12 months may feel more manageable. The amount is the same, but the behavioral experience is different. This can reduce present bias. Present bias is the tendency to prioritize immediate comfort over a larger future benefit. Keeping the money in savings gives you immediate emotional comfort. Investing gradually gives your future self a larger potential benefit without forcing you to make one dramatic decision. Fifth, choose an allocation you can actually hold. If a 100% stock allocation would make you sell during a 30% decline, it is not the correct allocation for you. A diversified mix of stocks, bonds, and cash may produce a lower expected return, but improve your ability to stay invested. The best theoretical portfolio is not useful if your behavior destroys it. Now let us examine 3 different households. Household 1 is a dual-income family with $12,000 of monthly take-home pay, $6,000 of essential expenses, stable employment, and good health insurance. If this family has $100,000 in savings and no major purchase planned, $36,000 to $72,000 may cover its cash needs, leaving $28,000 to $64,000 for longer-term goals. At a 7% real return over 20 years, $28,000 could grow to approximately $108,351. At the same assumed return, $64,000 could grow to approximately $247,690. Household 2 is a single-income family with $6,000 of monthly essential expenses, a commission-based job, and a mortgage. A 12 to 18-month cash reserve could be reasonable. That range would equal $72,000 to $108,000. For this household, keeping $100,000 in cash may not be excessive. The financial value of avoiding a forced sale or high-interest debt can outweigh the expected investment return. Household 3 is preparing to buy a $500,000 home in 18 months and expects to need $100,000 for the down payment and closing costs. That $100,000 is not excess cash. It is money with a short, defined time horizon. Investing it in stocks could create a serious mismatch between the investment risk and the date the money is needed. The same balance can be excessive for one household and perfectly appropriate for another. The amount alone does not tell you the answer. The timeline, stability, and purpose of the money tell you the answer. There is also a retirement angle. Suppose you are age 40 and keep $50,000 in cash until age 65. Under the savings assumptions in this illustration, the balance has approximately $59,542 of purchasing power at age 65. Under the 7% real return illustration, the invested balance reaches approximately $271,372. The difference is approximately $211,830. To generate $211,830 of additional retirement capital, you might need to save approximately $704 per month for 25 years at a 7% real return. That is why asset allocation can matter as much as budgeting. Cutting a $10 subscription may save $120 per year. Choosing the right long-term location for $50,000 can change the future value of the entire account by more than $200,000. This does not mean small expenses are irrelevant. It means your largest financial decisions deserve the most attention. We also need to discuss the risk of holding too little cash. If you keep only $5,000 in savings while your monthly essential expenses are $6,000, one ordinary emergency can force you to borrow. A $10,000 car repair charged to a credit card at 22% interest could cost approximately $2,200 in interest over 1 year if the balance remained unpaid. That cost can exceed the expected benefit of investing the emergency fund. The Federal Reserve reported that 59% of adults experienced at least one major unexpected expense in the prior 12 months in its 2025 survey. Source: Federal Reserve 2025. So the answer is not to eliminate cash. The answer is to make the cash reserve large enough to absorb realistic shocks without allowing every long-term dollar to remain idle. You should also consider deposit insurance and account structure. The Federal Deposit Insurance Corporation generally insures eligible deposits up to the applicable coverage limit per depositor per insured bank for each ownership category. If your balances exceed the relevant insurance limit, confirm how your accounts are structured and whether the institution is insured. Safety is not only about volatility. It is also about access, insurance coverage, tax treatment, and the stability of the institution holding the money. Now consider the rate environment. A savings account may pay 4.50% today and 2.00% several years from now. Your emergency fund does not need to depend on predicting interest rates, but it does need to acknowledge that cash yields are variable. If the account rate falls to 2.00% while inflation remains 2.7%, the pre-tax real return becomes negative. At a 24% federal tax rate, the after-tax return would be only 1.52% before state taxes. Against 2.7% inflation, the approximate real loss would be 1.15% in that year. On a $50,000 balance, that would reduce purchasing power by approximately $575 in 1 year. This is another reason to distinguish a reserve from a long-term investment. A reserve is designed for reliability. A long-term investment is designed for growth. Different jobs require different tools. This is not personalized financial advice. Consult a certified financial advisor for your specific situation, especially if you have variable income, significant debt, upcoming medical expenses, or a near-term housing decision. Now, let us state the fair conclusion. Keeping too much cash can be expensive, but keeping the right amount of cash can be one of the highest return decisions in your financial life. The conventional choice of holding cash wins when the money is needed within the next 1 to 5 years. It also wins when your income is unstable, your essential expenses are high, your insurance coverage is weak, or you would panic sell investments during a downturn. It may win when your family has one income, and replacing that income could take 12 months or more. It may win when you are preparing for a known purchase, such as a home down payment, tuition bill, or major renovation. It may even win when the expected investment return is higher, but the emotional cost would cause you to abandon the plan. Cash is not a mistake simply because its expected return is lower. Cash becomes a mistake when it is used for a job that does not require cash. If the money is for an emergency, keep it liquid. If the money is for a purchase in 2 years, protect it. If the money is for retirement in 25 years, evaluate whether cash can realistically preserve enough purchasing power. Most people miss the distinction between safety of principal and safety of purchasing power. A savings account may protect the number of dollars on your statement. It does not guarantee that those dollars will buy the same amount of housing, healthcare, food, or retirement income later. The real math shows that financial safety has 2 dimensions. You need enough liquidity to survive bad timing. You also need enough growth to survive a long life. The higher level principle is simple. Do not ask whether an asset is safe in isolation. Ask whether it is safe for the job, the timeline, and the risk you are trying to manage. Your emergency fund should protect your present. Your long-term investments should help finance your future. And every dollar that sits in between deserves an honest calculation. That is how you keep cash from becoming comfortable, invisible, and unnecessarily expensive.